bonds versus equities, and I'll tell you what I mean. So, we're still inverted. The 10-year is like 4.1 or 2 or something percent. And, T-bills 1 months are like 5.3. It's, it's like 100 basis points. And, and when I look at, the stock market seems really expensive if you look at CAPE ratio and, some people talk about concentration too in the top names. And there are other ways to look at it, market cap to GDP or whatever. So it seems to me like, we're getting this vibe, as everyone likes to say, from the Fed that, cuts are coming, which is not always a wonderful thing, but people seem to think it is wonderfully bullish. So if like on the forward curve of the short end of the rate curve, like the expectation is down, and we're still like inverted 100 basis points in the 10-year and stuff. I mean, it seems to me like you could easily get a situation where the reaction to whatever happens, geopolitically, Fed policy, whatever it is, pushes that 10-year up kind of substantially. And I think at current levels, I'm not sure equities would like that very much. That's sort of my
Yeah, well,
concern right now.
I think that is, I think that's a very reasonable concern. And part of the challenge in trading markets is, and particularly when you start trading bond markets, is like you have to trade against what's priced in, and what's priced in is, to be frank, like a very fast cutting cycle, right?
Mm-hmm.
What's priced in is by next summer we'll be at 350, and we're at 525 to 550 right now. That those sorts of cuts, is it possible? Of course it's possible, but those are the sorts of cuts that would come in a relatively substantial deceleration.
Right.
We're getting close to one cut every meeting starting in September. And that's remember back when the Fed was hiking at that level of aggression, inflation was very, very elevated, right? They were behind the curve and inflation was very elevated. That sort of cutting cycle, it's not quite a crisis cutting cycle, but it is would be consistent with a recessionary environment, relatively steep recessionary environment. And so it's not clear that that's going to happen. And as you say, if the cuts don't come, then yields will rise, and if yields rise, it will directly affect the economy, but also affect equities directly through rising discount rates.
Right. And I feel like even like less cut than expected at this point is like hawkish, right? It's like, go ahead, you cut whatever, they're the usual quarter, they're 25-point cuts or whatever. And maybe that's like a lot less over the next, some months than expected. And that scene, is kind of hawkish. It just, it feels like a risky moment, frankly, to me.
Yeah, I mean, I think for financial assets, it is a risky moment because you have essentially such extreme expectations priced in. In stocks, you have, it's not just that you have the various ratios that you refer to as being elevated, which they certainly are, but actually, I think one of the important things is almost all those ratios are priced off of forward earnings,
Mm-hmm.
and it's important to recognize forward earnings are not actual earnings. Right? I think
That's right.
people are sort of like, well, forward earnings, like that's it's obvious, that's what the baseline is. Okay, well, like when the earnings get delivered, then they're earnings, not until they get delivered, right?
Right.
And so I think we have on the stock side a valuation, extreme valuations, but also relatively extreme earnings growth expectations, in the mid double digits to high double digits over the course of the next 18 months. That's very, very high for a late cycle environment, for a late cycle economy to get that sort of earnings growth. And then on the flip side, we have very high expectations of easing in the bond market. And you sort of have, in many ways, like an expectations bubble going on right now in both the stock market and the bond market that are intersecting each other, as you note, and could easily be disappointed simply, if the Fed is just a little more cautious than expectations, and maybe if growth just doesn't quite deliver the extremity of the earnings expectations that are currently priced in.
Right. So what do you do about it? What do you buy? I mean,
Cash. I think I
Exactly.